Listen to me very carefully. I've been in this game for 40 years, and I can tell you with absolute certainty that the market is handing you an opportunity right now that most people are too scared to take. The headlines are screaming that artificial intelligence is going to destroy three of the most cash generating, deeply embedded, operationally dominant software businesses on this planet. The crowd is running for the exits. Stocks are down 30, 40, even 50% from their highs. And here is the cold, hard truth that nobody on television is going to tell you with the mathematical precision it deserves. This kind of fear driven sell off is not a warning to stay away. It is a once in a cycle invitation to pay attention. The investors who built generational wealth did not do it by following the herd. They did it by going where the herd was running from. That is exactly what we are doing today. My name is Stan Druckenmiller. I ran money for George Soros. I managed one of the best long-term track records in macro investing, and I have seen this pattern repeat itself more times than I can count. A dominant narrative takes hold, the market panics, and the price of a great business gets disconnected from its underlying value. That gap between price and value is where fortunes are made. And right now, that gap is enormous in three specific software companies. Let me teach you something the financial media will never teach you. The price of a stock and the value of a business are two entirely different things. They diverge most violently when fear is at its maximum. That is not an opinion. That is the entire history of capital markets condensed into one sentence. When a narrative turns negative, when the headlines are screaming that a company is doomed, when analysts are downgrading and retail investors are panic selling, the price of that stock craters far below what the underlying business is actually worth. And that gap is where you make your money. The dominant narrative destroying valuations across the software sector right now is artificial intelligence. The story goes like this: AI is coming. AI will replace everything. Any software company that charges a subscription fee for services that AI might one day replicate for free is essentially a dead business walking. The market has taken that narrative, amplified it through social media, reinforced it through algorithmic trading, and proceeded to price some of the most dominant cash-generating software businesses in the world as if they were already bankrupt. That is not analysis. That is panic. And panic, when it is mathematically unjustified, is the most powerful wealth creation tool available to a disciplined investor. I am not here to tell you that AI is not real. It is very real. I am not here to tell you that AI will not change the software landscape. It absolutely will. What I am here to tell you is this: the market's current pricing of that disruption in these specific businesses is so extreme, so divorced from the actual free cash flow numbers, the actual customer retention data, and the actual switching cost reality, that it has created one of the most asymmetric setups I have seen in this sector in years. The first business is Intuit. You know them as TurboTax and QuickBooks. If you have ever filed your own taxes or run a small business in America, you have almost certainly used one of their products. This is not a startup. This is not a speculative bet on future revenue. This is a company with $6.84 billion in free cash flow in the last 12 months, an established 85% market share in small business accounting, and a product so deeply embedded in the daily financial operations of millions of businesses that switching away from it is genuinely painful. Let that sink in before we talk about the price. The stock is down nearly 50% from its all-time high of $814. It is currently trading around $405. Year to date, it is down 35%. In the last 6 months alone, it is down 40%. The market capitalization of this business is approximately $113 billion, with an enterprise value of $125 billion. That $12 billion difference represents their debt. And here's where you need to start paying attention to the math. With $6.84 billion in free cash flow last year, Intuit could theoretically pay off every dollar of that debt in less than 2 years of a single year's cash generation. That is not a company in distress. That is a company being priced like one. Now, let us talk about the valuation multiple, because this is where the opportunity becomes impossible to ignore if you are thinking clearly. This stock used to trade at 40 to 50 times free cash flow. That was the premium the market was willing to pay for a dominant, growing, highly sticky software business. Today, that same business, still generating billions in free cash flow, still growing, still controlling 85% of its core market, is trading at 16.5 times free cash flow. That is not a slight discount. That is a collapse in what investors are willing to pay, driven entirely by fear and narrative, not by business deterioration. The price to sales ratio sits at 5.6 compared to Microsoft's 10. And Intuit actually carries a higher gross profit margin than Microsoft in its core business. Yes, there are legitimate concerns here, and I will not pretend otherwise. The MailChimp acquisition from 2021 has been a mess. Market share dropped from 70% to the low 50s, and they have been losing customers in that segment consistently. Revenue growth is slowing from 17% last quarter to a guided 10% this quarter. Those are real negatives, and they belong in your analysis. But here is the question you must answer with discipline. Has the business deteriorated to a level that justifies a 50% reduction in stock price from its highs? Has QuickBooks lost its stranglehold on small business accounting? Have millions of businesses suddenly migrated to an AI alternative? The answer is no. The switching costs for an established business with years of invoices, customer records, payroll history, and accounting data inside QuickBooks is not a technological problem. It is an operational nightmare. Businesses do not rip out their accounting infrastructure on a whim. They stay because staying is dramatically easier than leaving. When you run the numbers conservatively, using revenue growth assumptions of 5 to 11%, free cash flow margins of 28 to 32%, and a terminal multiple of 18 to 24 times earnings, you arrive at an intrinsic value range with a low of approximately $400, a middle of $600, and a high of $890 per share. The stock is currently sitting at the absolute floor of that range. That is the mathematical picture. The narrative is ugly. The numbers are not. Now, before I move to the second business, I want to pause here because this is the exact moment where most people make a mistake. They hear the numbers, they understand the logic, but they do not act because they are waiting for someone to tell them it is safe. If you want to go deeper on this analysis, I put together something that walks through the entire framework in detail. It is in the pinned comment below this video. The level of institutional grade analysis I am handing you here is the kind of thing hedge funds charge millions of dollars to access. You are getting it for nothing, but only if you take the time to look at what I left for you. Go to the pinned comment now. I will wait. The second business is Salesforce, ticker symbol CRM. You may not use it yourself, but if you have ever received a sales call from a Fortune 500 company or a marketing email from any major brand, there is a very strong probability that Salesforce was the engine running the entire operation behind the scenes. They are the global infrastructure for enterprise customer relationship management, and they have been that infrastructure for over 2 decades. The stock is down 28% in the last 6 months. And just like Intuit, the reason the market gives you is artificial intelligence. The fear is that AI agents will replace the entire Salesforce platform, that companies will stop paying for CRM seats when an AI can manage customer relationships autonomously. Here's what the numbers actually say. Free cash flow last year, $14.5 billion, 5-year average free cash flow, $9.6 billion. Net income last year, $7.5 billion. 5-year average net income, $3.9 billion. I need you to notice something critical in those numbers. Free cash flow is nearly double net income. Most retail investors focus on net income because that is what the headlines report. Net income is far easier to manipulate through accounting decisions. Free cash flow, the actual cash the business generates after capital expenditures, is the number that tells you the truth about a business. And the truth here is a company generating $14.5 billion in real cash last year, currently priced at a market capitalization of $176 billion. That gives you a price to free cash flow ratio of 12.3 times. For a business that has grown revenue at 20% per year for the last decade, that is an extraordinary value if the business does not fall apart. The concern from Wall Street is that recent guidance came in at 10 to 11% growth, well below their 5-year average of close to 15%. Smaller businesses are reportedly signing up at a slower pace. These are legitimate data points, and they belong in any honest analysis. But Salesforce is not sitting still and waiting to be disrupted. They are building their own AI platform called Agentforce, a direct bet that artificial intelligence makes their platform more valuable, not less. That companies will use AI agents built on top of Salesforce infrastructure rather than replacing Salesforce with those agents. Whether that bet pays off at full scale is the central question for this business over the next 5 years. But you are not being asked to pay a premium to find out. You are being offered the chance to own it at a price to free cash flow of 12 times while that question gets answered. Analyst estimates, with all of their built-in human bias acknowledged, show earnings per share growing from roughly $11.88 today to over $21 by 2029, an increase of approximately 80% over 5 years. Revenue growth is projected at 9 to 11% annually. The gross profit margin of this business sits at 78%. Over the last 10 years, profit margins have expanded from low single digits to 18% last year, with the 5-year average at 11.3%. The trajectory is one of a maturing, increasingly profitable enterprise software business, not a dying one. Running conservative assumptions. Revenue growth of 5 to 10%. Free cash flow margins of 25 to 35%, and a terminal multiple of 14 to 22 times earnings produces an intrinsic value range of $190 on the low end, $320 in the middle, and $520 on the high side. The stock today sits at the low end of that range. The math does not tell you to panic. The math tells you to look more carefully. The third business is ServiceNow, ticker symbol NOW. And I want you to understand immediately that this business is categorically different from the first two in one very specific way. The switching costs here are not just high, they are institutional. ServiceNow does not sell software to individuals or small businesses. They embed their platform into the operational infrastructure of hospitals, governments, multinational banks, and the largest corporations on earth. IT ticketing systems, HR workflow automation, legal request management, facilities, operations, all of it runs through ServiceNow inside these organizations. This is not software you cancel on a Tuesday afternoon because you found a cheaper option. This is software that is wired into how thousands of employees do their jobs every single day. Ripping it out is not a business decision. It is a multi-year operational transformation that most organizations have absolutely no appetite to undertake. The stock is down over 30% this year and over 50% from its highs in 2025. The AI narrative is identical to what we heard with Intuit and Salesforce. AI agents will replace the platform. Why pay for ServiceNow seats when AI can handle workflows automatically? The valuation was stretched going into this fear cycle. which made the selling particularly brutal when it arrived. But now, let us look at the actual numbers with the clinical precision they deserve. Market capitalization, $105 billion. Enterprise value, $111 billion. The difference of approximately $6 billion represents their net debt. Free cash flow last year, $4.5 billion. That means ServiceNow could theoretically retire its entire debt load in approximately 1.5 years of free cash flow generation. The price to free cash flow ratio sits at 23 times, which is higher than Salesforce, but must be evaluated in the context of growth, and the growth numbers here are genuinely exceptional. Revenue is compounded at 30% annually over the last 10 years. Over the last 5 years, 24%. Over the last 3 years, 22.5%. These are not the growth rates of a business being disrupted into irrelevance. These are the growth rates of a business with enormous pricing power and a deeply loyal, deeply embedded customer base. Here is a number that strikes me as most remarkable about ServiceNow's financial discipline. Over the last 5 years, their average annual free cash flow generation was $2.9 billion per year. Their total acquisitions over that same 5-year period amounted to $2.35 billion combined, not per year, combined. That means this business is generating extraordinary cash flow and largely reinvesting it organically rather than buying growth through expensive acquisitions. That is the capital discipline of the highest order, and it is a quality that does not show up in the headline numbers, but matters enormously when you are evaluating the long-term health and sustainability of a business. Analysts project a doubling of revenue over the next 4 years and a near doubling of earnings per share. I do not build my models on analyst optimism, so I ran far more conservative assumptions: revenue growth of 9 to 17% per year, free cash flow margins of 30 to 36%, and a terminal multiple of 16 to 22 times earnings. Even with those disciplined, conservative inputs, the intrinsic value range comes out to a low of $95, a middle of $160, and a high of $260 per share. The current price sits just above that low end of the range. The question you have to ask yourself honestly is whether your conviction in the AI disruption thesis is strong enough to justify pricing this business at the absolute floor of a conservative valuation model. Because if you are wrong about AI destroying ServiceNow, and I believe you are, the upside from here is substantial. Let me close with this. I have been through more market cycles than I care to count. I have seen the crowd panic out of great businesses time and time again, and every single time the investors who had the discipline to look past the narrative and focus on the numbers came out ahead. The 3 businesses I just walked you through are not speculative bets. They are cash-generating, deeply embedded, operationally dominant software companies that the market is currently treating as if they are obsolete. They are not obsolete. They are being mispriced. Before I sign off, I want to make sure you do not leave empty-handed. If you found this analysis useful, I put together a resource that goes into even more detail on the framework I use to identify these opportunities. It is in the pinned comment. Go check it out. And remember, the crowd is always wrong at the extremes. Be disciplined, be patient, and let the math guide your decisions. That is how you build wealth over the long term.